All right, it's time to go back in time to 1910. 6 men sit at the Jekyll Island Club and draft a plan to reform the nation's banking system. 3 years later, President Woodrow Wilson signed it into law, and the Federal Reserve System was born. Now, over a century later, what does the Federal Reserve actually do? How does it work? Let's explain. It's time for Yahoo You. Still with us is our very own in-house Fed expert, Brian Cheung, to break it all down for us. So let's start with the basics, the structure of the Federal Reserve System and how it works.
Yeah, so in the financial media, we talk so much about the Federal Reserve, but I feel like sometimes we need to take a step back and say, what is it? So the Federal Reserve is the nation's central bank here in the United States, and it has three main functions. The first is conducting the nation's monetary policy. The second is making sure that markets are financially stable. And the third is supervising and regulating financial institutions. Now, monetary policy is the one that people fixate the most on, right? How it sets and changes interest rates, and as of late, what it does with its balance sheet and the assets that it has on there. Now, it does have a mandate from Congress. It has three, technically. People say it's a dual mandate. The first is stable prices, so targeting inflation is the measurement that the Federal Reserve uses. And the second is maximum employment, which is the unemployment rate. The third, however, that a lot of people miss is actually moderate long-term interest rates. That is something that's a little bit of a more ambiguous term for the Fed. But regardless, here's the structure of all of it in terms of the people that sit on there. We talk about Jerome Powell. He is the chair of the Fed. There are, at times, right now, actually, we only have 4 other sitting members on the Federal Reserve Board. They are based out of Washington, D.C. And the Federal Reserve also has a network of 12 Federal Reserve districts across the country. So it's basically carving up by geography the entire United States, including Hawaii, Alaska, and also Puerto Rico. Each of those 12 districts has a president, and the president is someone who basically, and you can see the chart right there, they are in charge of making sure that the economic condition in there is reported back to the board. Those members also rotate into what they call the Federal Open Market Committee, which actually sets rates. There are 4 Federal Reserve presidents that rotate in.
Okay, so you just mentioned the FOMC setting interest rates. I've always heard this term that the Federal Reserve is the bank to the banks. So when they're setting interest rates, are they directly setting the interest rate that JP Morgan Chase is charging me, or are they going straight to, are they setting the interest rate for the banks?
So we talk about, is the Fed going to raise rates? Is the Fed going to raise rates? Well, it doesn't just magically do that. So what they say is what we call a target range. So for example, right now, the target range is between 2.25% and 2.5% in terms of the federal funds rate. Now, the rate itself is aspirational, but how the Fed does it is by being the banker's bank, as you mentioned. So the Federal Reserve will adjust the amount of interest that it pays on reserves that banks like JP Morgan Chase, Citigroup, Wells Fargo will park at the Federal Reserve. When it raises interest rates, it makes it more attractive for the bank to put money into the Federal Reserve. When it lowers interest rates, it incentivizes the bank to take money out of the Federal Reserve. Now, what does that mean for the economy? That means that in a lower rate environment, the banks have more money on their balance sheets to lend out. So it's a stimulative measure by which the Federal Reserve can give money to businesses, give money to the average American to spend. So this is kind of the mechanism that the Federal Reserve uses in terms of its interest rates to either contract or grow the economy.
And then just quickly, there's the bank balance sheets, and then there's the central bank balance sheet, which we have heard so much about over the past year or so.
Yeah, so the balance sheet was something that was never really conceived as part of the original Federal Reserve when it was back in the 1910s. But the Federal Reserve now has a number of assets on its balance sheet. Mortgage-backed securities, those are agency MBS, and then also treasuries that it purchased in the post-crisis period, which it did to basically make sure that the economy could get back on track after the horrible recession that we saw in 2007, 2008. The question that we hear a lot about now, especially as we head towards the policy meeting next Wednesday, is what is the Federal Reserve going to do in terms of reversing those holdings? How does it do that? And under Janet Yellen, they initiated a plan to slowly roll off the amount of MBS and also treasuries that it has on its balance sheet. But the question is, where does it stop now? And we don't have a timeline necessarily yet. Powell has said it might be towards the end of this year. We might get more granularity on that next week. But it's basically the process of undoing what they call quantitative easing. And by intuition, the term for that now is quantitative tightening.
Yes, exactly. All right. Thanks for walking us through all that. Brian Cheung has a second career coming as a professor. Appreciate it.